The subject of this panel is monetary policy and household demand. Meaning the transmission of monetary policy depends to a large extent, or to a major degree, we could say, on how interest rates affect housing construction and the demand for consumer spending, consumer durables. And these two variables often dominate the business cycle. They also play a big part in the credit cycle as they drive household borrowing. And as Professor Sufi points out, the impact of interest rate changes will depend on the nature of these debt contracts and on the level of household indebtedness. And of course, central bankers are well aware that the legacy of excessive debt can depress demand. Actually, in fact, it can also weaken banks. And so he suggests adding equity-type elements to mortgage debt contracts, as we just heard, with the idea being with an equity element, the lender could take some exposure to the value of the house, for instance. The debtor could give up some of the gain when house prices rise in return for a lighter debt burden. And of course, this could change significantly how monetary policy works. It could also make the financial system safer. So there are many interesting dimensions to these questions. Now I will give the floor in turn to each of the panelists, asking each of them to speak for, say, 10 minutes. And then I shall open the floor to questions to Professor Sufi or to the panel. And let me start in alphabetical order. So Haruhiko, Kuroda, the floor is yours.
Thank you, Christian. It is, of course, a great honor to be able to participate in this panel discussion today. As you may know, the Bank of Japan introduced its quantitative and qualitative monetary easing, or QQE, in April 2013. One tentative conclusion that can be drawn from the experience of a little over 2 years is that central banks can overcome the zero lower bound as long as the policymaker commit decisively to fulfilling its mandate with well-designed unconventional monetary policy measures. To give you some idea of the outcome since the beginning of the QQE, the unemployment rate has fallen 0.8 percentage point, and the CPI inflation has risen about 1 percentage point. Other major central banks have also been successful in stimulating demand through their own unconventional policies. It has become a common understanding among the central bank community that unconventional monetary policy, despite some lingering skepticism from the academic front, has actually proven to be effective. This is best characterized by a famous quote from the former Fed chair, Ben Bernanke. He said, "The problem with QE is it works in practice, but it doesn't work in theory." In that case, the question remaining about unconventional monetary policy is not whether it works, but why it works. The rest of my remarks will focus primarily on this issue from both theoretical and practical perspectives. First, let me start with term premiums. Whether central banks' large-scale asset purchases succeed in reducing term premium hinges upon whether the preferred habitat hypothesis holds. Some influential academics deny this effect, claiming that open market operations should be largely ineffective to the extent that they fail to change expectations regarding future policy. This argument is presumably what was in Mr. Bernanke's mind when he said that QE didn't work in theory. Among central bankers, however, it is becoming increasingly accepted that term premiums can actually be reduced by large-scale purchases of long-term bonds through changes to their demand-supply conditions. Experience has further convinced us that the fall in long-term interest rates, in turn, affects the price of other financial assets such as equities and private credit through portfolio rebalancing, as predicted by James Tobin's general equilibrium theory. Economists has recently started to embed this preferred habitat mechanism in their macroeconomic models so as to explicitly incorporate this transmission channel of QE. Second, forward guidance, which is another element of unconventional monetary policy, is generally supported both in theory and in practice. In theory, forward guidance could pin down the future expected path of policy rates by clarifying the central bank's policy reaction function and thereby reducing the volatility of financial markets. In fact, forward guidance, together with a strong commitment to policy objectives, has been used effectively in various policy settings across jurisdictions. Third, let me discuss the quantitative aspect of quantitative easing. Does the size of the central bank's balance sheet matter in itself, or if so, why? Some theoretical economists argue that QE is effective from the viewpoint of monetary financing of the government budget. However, this is the opposite case of Bernanke's quote. It works well in theory but cannot be applied in practice. Monetary finance is widely understood to run the risk of eroding the credibility of the central bank and thereby potentially increasing risk premiums rather than reducing them. Furthermore, recent experience in the United States and the United Kingdom has demonstrated that an unconventional monetary policy works even in the midst of substantial fiscal consolidation. In the case of Japan, the joint statement of January 2013 clearly stated that the Bank of Japan would pursue a 2% inflation target while the government committed to ensuring long-term sustainability of the public debt. Thus, from the beginning, there was no intention at all that QQE would work through facilitating fiscal expansion. While monetary finance is not on our agenda, the size of central bank balance sheets is, in my view, important for different reasons. Since inflation is widely perceived to be ultimately a monetary phenomenon, the creation of a massive quantity of money would be a strong signal of a central bank's commitment to fighting deflation. It is in this context that an unprecedented expansion of the monetary base plays an essential role in our QQE. Fourth and lastly, I will discuss what I believe is a very critical transmission channel of unconventional monetary policy, the expectation channel. This overlaps with the signaling effect associated with the quantity that I just mentioned. One possible problem is that the theoretical foundations seem not to be well established. Standard theories simply assume that rational expectations automatically hold, while they tend to be silent on exactly what it would take to change the way firms and households formulate their expectations. I'm quite confident, however, that a strong commitment to policy objectives, clear and consistent communication, and decisive action to fulfill the commitment would collectively be powerful enough to have a significant impact on inflation expectations and therefore on the behavior of private entities. This expectation channel is crucial for Japan in particular, where the deflationary mindset, so firmly embedded for such a long period, needs to be dispelled completely. Before I conclude, I would like to quote a word of Walter Heller, economic advisor under President Kennedy and Johnson. He said, "An economist is a man who, when he finds something works in practice, wonders how or if it works in theory." If this adage is true, I suppose we can look forward to a much deeper theoretical understanding of the secrets of unconventional monetary policies in the coming years. At the same time, practitioners in central banks cannot afford to be complacent. Speaking of the Bank of Japan, for instance, inflation is still well below our target, although this is partly due to the temporary influence of low oil prices. While our projection is that inflation will be in the neighborhood of 2%, most likely around the April-September period of 2016, the risks to that scenario cannot be ignored, particularly when the global economy is full of uncertainty, including over geopolitical factors. That being said, our commitment to achieving the 2% inflation target will never be compromised. With our unwavering determination, I am confident we can achieve that goal. Thank you.
Thank you. Thank you very much. I would like now to turn to Stefan Poloz. Give you the floor.
So Professor Sufi's thesis is logical. It's very well supported by the evidence laid out here and in his book, which is co-authored with Atif Mian. His thesis is also, I would say, embarrassingly simple and intuitive. It leads to a policy conclusion that the key to recovering from a balance sheet recession like the one we've been locked in for many years is simply to restructure debt. You get people who are underwater above the surface and their spending recovers. And that sounds like highly targeted fiscal policy rather than monetary policy, something worth thinking about. In Canada, I think we can offer some empirical support for his thesis, I guess I could say from the other side of the ledger. When the crisis hit in Canada, we had no bubbles, we had no excessive leverage, we had no banks that needed bailing out, but we still felt the full impact of the global recession, and we cut interest rates basically to the effective lower bound to offset that. And the good news is, given our favorable starting conditions, monetary policy has worked very well. We've seen a significant rise in household spending and, of course, leverage in response to low interest rates. Now, we worry about the associated financial stability risks. Too much household debt and a hot housing market, and those are the symptoms that others had just before the crisis. Now we've got them. So few of us saw the crisis coming, and fewer still imagine how long this might take for the world economy to recover. And avoiding a repeat obviously requires a more resilient financial architecture, supported by our new regulatory framework, but it also requires that we integrate financial stability risks into monetary policy formulation. And I use the word integrate with some care because it's conceptually much stronger than simply monitoring financial stability risks and taking them into account in policy formulation. We're in the process of what I'd like to say reinventing central banking. It's a job that has quite a ways to go, though. To this point, efforts to add financial stability issues to monetary policy formulation are a bit like the process of renovating the treasured family home over and over to respond to evolving needs. But what we really need is a whole new macroeconomic financial architecture, a grand synthesis, if you will, to support monetary policy making. Now, Professor Sufi's research makes an important contribution to this effort. And a key element in this evolution of central banking is going to be to treat uncertainty very seriously. If we've learned nothing else in the last 7 years, it's that there's much that we simply do not know. And as a result, central banking will become even less like mechanical engineering, even less about the optimization problems, intractable models. It will become a lot more about simple risk management. And we've taken some early steps in that direction. At the Bank of Canada, our risk management framework is, of course, anchored in an inflation target, but it acknowledges that the inputs into our decisions are highly uncertain. And those inputs would include a wide range of things like your outlook for economic growth, or how much excess capacity there is, or what the neutral rate of interest is. These are very typical inputs, but all expressed not as points, but as judgmental ranges. So then, in light of recent experience, we must add to this mix some new concepts, financial stability risks, like household leverage or excessive risk-taking by investors in various ways, measured in various ways. So taken together, these considerations manifest themselves in a policy position that is not a point. It can't be described as a point, but more like a zone. I like to think of it as a neutral zone. And in that zone, the various risks that we are facing appear to be balanced from the policy standpoint. So when policy is positioned in this neutral zone, the central banker has a reasonable expectation that the inflation target will be achieved over a reasonable time horizon, and that financial stability risks are likely to evolve constructively through time. But what happens when a shock disturbs that balance? Well, first, because the situation is uncertain, it takes a big shock to cause any policy reaction at all. We're not in a fine-tuning world, but instead we're in a world where we must manage the big risks and then strike a balance between all the others. So let me just illustrate briefly with a specific example. So a year ago, we were becoming quite confident that the Canadian economy was on its way home. Exports were gathering momentum, of course, because the U.S. was. Companies were starting to invest again. Job creation was on the rise. That's the hoped-for natural sequence. And we were concerned about household debt, for sure, but with the economy on the mend, we thought financial stability risks would ease naturally as we got home. In short, policy risks and financial risks appeared to be balanced. We were in the neutral zone. But then oil prices collapsed. Given the importance of that sector to our economy, this posed a material downside risk to the outlook for growth and for inflation. As well, it was exactly the kind of catalyst that we would worry about in the light of what it could do to financial vulnerabilities and create financial stability risks. Well, in the context of a risk management framework, the oil shock was big enough to move us out of the neutral zone. And so we eased monetary policy in January, and this balanced the risks, rebalanced the risks, if you like, to the economic outlook, got us back on track to have the economy back in equilibrium with inflation on target in about 2 years' time. So the rate cut, though, was very controversial. And the biggest question people asked was, well, you're just making financial vulnerabilities worse, aren't you? Of course, by cutting rates, we were hoping to boost spending to offset the impact of the oil shock, and that means more borrowing. But our primary mission is to achieve our inflation target. This means getting the economy back to full capacity over a reasonable time frame. Other issues must be subordinate, and I think of them as side effects, same term that Professor Sufi has used. And my metaphor is more blunt. It is, if the doctor says you need surgery to avoid death, the side effects usually don't deter you. You just go ahead and manage them somehow. But a more important perspective is that the economic impact of the oil shock will be to reduce national income, which in turn means that leverage ratios that we watch so carefully will go up, whether there's any more borrowing or not. Accordingly, acting to cushion the blow to the economy by cutting rates actually mitigates the rise in those leverage measures. In other words, there are risks associated with doing nothing, too. Indeed, it's very often the case that the best contribution the central bank can make to alleviating these financial stability risks is to pursue its primary mission, because stronger income makes high indebtedness more sustainable. A more subtle point is that we need to look beyond simple macro averages when assessing financial stability risks, and that's the central point that's at the heart of Professor Sufi's thesis. When we cut rates to stabilize the economy, we don't picture some heavily indebted household going out and adding to their debt pile. Rather, we picture a household with no debt at all, deciding finally to buy a house and taking out a mortgage. And it's true that aggregate leverage goes up in the process, but it's not obvious that it is less sustainable. So even though financial stability concerns are very important to us, we must keep them in their proper place. We must acknowledge, of course, the possibility that financial stability risks at some point become so great that they become primary. But preventing this is the job of macroprudential policies, not usually the central bank. Now, obviously, it's essential that if you use macroprudential policies, you don't unintentionally render monetary policy ineffective. And it seems like in our case, we've managed that because the macroprudential changes we've made seem to have reduced the risks among the most vulnerable. And that's been a helpful thing. So it's left monetary policy more or less with the same power as we had in the beginning, so far. So these observations are to suggest that we are managing, I would say, to find our way, conducting monetary policy in a framework anchored by an inflation target, taking account of both fundamental uncertainty and a range of financial stability considerations that never entered our deliberations in the past. but understanding how financial imbalances and distributional effects arise and how they evolve through time and how they affect macroeconomic outcomes, i.e. the transmission mechanism, as in Professor Sufi's paper, that's the task that lies before us. And his research is making significant advances for us in this space. Thank you.
Thank you very much, Steve. Then I would like to turn to Alexandre Tombini. The floor is yours.
Thank you very much, Christian. I would like to thank the BIS for inviting me to be part of this panel. It's an honor to be paying tribute to a great leader of the BIS, Andrew Crockett. Our discussion here today follows a rich and instigating lecture from which I derive various issues, all interesting, out of which I take three. First, using a single representative consumer in our models to account for the complexity of the monetary transmission might miss important heterogeneity effects that can have macro consequences, like, for instance, overestimating responses to cutting policy rates and to the unconventional monetary policy instruments. Second, in crisis time, the policy response to a debt-driven financial meltdown should precisely take into account this heterogeneity and inject resources to prop up households with negative net worth and with a higher propensity to consume, that is, be more aggressive on mortgage restructuring, as we have heard from our lecture today. And third, in normal times, in addition to adequate regulation, the financial industry should provide better risk sharing through inter alia debt contracts that could be transformed into shared responsibility mortgages, for example. For the sake of time, I will not address all these three important issues in depth, but rather focus on the issue of monetary policy and household demand from an emerging market perspective. In a sense, my country, Brazil, is a special country case where households are indeed heterogeneous. Past monetization of high, unsustainable public debt led to hyperinflation, and learning from our crisis, we stabilized our macro economy some 20 years ago and are now busy developing the housing market using micro and macroprudential tools. From Brazil's experience, two lessons can be drawn. First, that one of the most robust empirical findings is that the household demand does respond to movements in the policy interest rate. Second, that prevention of excessive household indebtedness is paramount in emerging economies and can be done using a toolbox comprising intrusive supervision, conservative regulation, and sound macroeconomic policies. Regarding the first issue, although several transmission mechanisms are in play, the most important is banking rates. Movements in the policy rate and inflation expectations are translated into changes in deposit rates and market-based lending rates, having an impact on household consumption. But beyond the impact of monetary policy on household demand through the classic channels, one fundamental change that has happened is macroeconomic institutional stability. Those explain the sea change and financial deepening that the credit markets has undergone in the last 10 years, when credit to household has expanded from around 10% of GDP to more or less 25% these days. First, macroeconomic stability and lower inflation allowed households to extend their planning horizons and raise their confidence, which are key elements to engage in debt markets. Second, inclusive economic growth has led to a sharp decline in poverty and inequality. More than 40 million people joined the middle class, and millions entered the formal labor market. On the institutional and the microeconomic front, credit market reforms reduced legal risks and led to the creation of new financial instruments and distribution channels, which were often more suited to the needs of the potential new clients, thus contributing to financial inclusion. Therefore, the scope of people that are directly sensitive to credit conditions today has risen significantly in recent years, enhancing the effectiveness of monetary policy. So are we in Brazil following the footsteps of advanced economies that allow excessive household debt, especially in housing loans, and that led us all to the financial collapse of the global financial crisis? Are we not listening to the warnings of Professor Sufi? My answer is that I don't think so. We are precisely treating these risks with preventive measures. In a sense, because of our inequality has been reduced, our households today are more homogeneous and respond better to monetary policy action, but we can develop a solid housing market with controlled systemic risk. From this financial stability perspective, we always had a very strict set of micro and macroprudential rules. Indeed, the Brazilian housing markets has been highly regulated. The market has embedded features that makes it less prone to financial distress. The LTV ratios are relatively low. The vast majority of borrowers hold only one mortgage, and most of the mortgage contracts are characterized by a constant amortization system by which the initial installments are higher than the final ones. And also securitization in the system is very limited. Moreover, at the outset of the global financial crisis, we have used macroprudential tools to mitigate risks. The objective was to make the financial system even more resilient and avoid excessive household leverage in a moment where easy global money was creating a bit of an excessive euphoria among Brazilian households. For instance, we adopted a number of measures in 2010 and 11 to mitigate risks associated to increasing LTV ratios and stretching maturities, especially for car loans and other durable consumption financing. Essentially, we doubled the capital requirement relative to Basel standards for certain risky operations. And we got the proof of the pudding now with the GFC. In recent years, what we have seen was the credit expansion has become more moderate, in line with a long-term sustainable path. The credit slowdown is taking place uneventfully from a financial stability perspective. Having said that, we do share Professor Amir Sufi's concerns related to the risks arising from highly leveraged households and to the asymmetry of risk sharing in modern financial systems. But we need, as an emerging market, to allow for growth in our debt market, while ensuring that individual and systemic risk remains under control. The route we took has been to use regulatory tools to control and limit excessive leverage. For instance, we have set maximum values for LTV ratio for household credit in 2013. We also set limits for associated debt service to income ratio for payroll guarantee loans, and also raised the minimum payment for credit cards balances. Professor Atif Mian and Amir Sufi's findings also suggest that despite the use of prudential tools, household debt retains a potential destabilizing effect on the macroeconomy. In fact, their central policy prescription is to introduce more risk-sharing in debt contracts, that is, to make them more equity-like. A natural question is why financial systems have evolved to be so reliant on debt. One reason that has been pointed out by many scholars, including the two professors, is that debt often has favorable tax treatment relative to equity. For instance, corporations usually can deduct interest payments from pre-tax profits and therefore reduce the corporate income tax bill, but they cannot deduct dividends. In Brazil, for instance, this is not quite the case. Alongside with dividends, corporations can pay their shareholders up to a limit interest on their own capital. This interest on own capital can be deducted from pre-tax profits, just like interest on liabilities. This reduces the tax advantage of that relative to equity. Amir's suggestion on making mortgage mortgage more equity-like and less debt-like is thought-provoking and deserve total consideration. I believe, however, there are some issues that need to be carefully considered. One concern is the risk of asset liability mismatches, given the fixed value of bank deposits. It seems that a large part of the population has a clear preference for safe asset, that is, they may not be willing to hold risky assets instead of deposits. And of course, we need to keep in mind the fundamental role of bank deposits in the modern economy, particularly in the payment system. A further question is whether this mechanism, the equity-like mortgages, will not lead to a meaningful reduction in the size of the mortgage market. The Brazilian experience shows that frameworks that do not provide the right balance between debtors and creditors hinder the development of credit. To conclude, let me provide you with some final thoughts on the current juncture in Brazil, where the economic slowdown has created some challenges today for the management of household finances. As you may know, we are conducting a classic economic adjustment, which is necessary to reduce domestic and external vulnerabilities, put the public debt back on a declining path, and send inflation back to its target by the end of 2016. This adjustment process takes a toll on short-term growth, but is key to restore sustainable growth in the upcoming years. Against this background, households are adjusting their balance sheets in an orderly way, moderating consumption and acquisition of new credit. Many are also renegotiating credit conditions. The debt service to income ratio, which had increased during the credit expansion and peaked in 2011, has since stabilized. Non-performing loans in the financial system remain low, and the banking industry remains well capitalized and well provisioned. In conclusion, the next consumption recovery should take place at a moderate and sustainable pace, hand in hand with a sustainable credit expansion and consistent with an envisaged investment-based growth. So what we have done in Brazil through the expanding phase of the credit cycle was to rein in excessive risk-taking and through the use of micro and macroprudential instruments, limited excessive leverage, especially in household financing, and this has proved to be doable in the sense that this deleveraging process is occurring today in an orderly fashion in the face of a slower economy today.
Many thanks to the panelists who have contributed to this debate, and many thank you very much to all of you for attending and participating actively. Thank you.